Hi, I'm Tom Elliott here at 3AW and welcome to another financial markets report for Hodges Real Estate. I have to say that the recent volatility in share markets is like nothing I've seen in many years trading the financial exchanges. Now, to bring you up to speed, what's happened is the US government has always had a AAA credit rating. Standard & Poor's has lowered that one notch to AA+, and the impact on markets was absolutely substantial. Firstly, the Australian dollar got hammered. It went from $1.10 down to just under $1 US. Secondly, stock markets were routed. We had falls of 4%, 5%, 3% one day after the next. Wall Street one night actually fell 6%. And then in the last couple of days, we've seen one of the biggest rallies in shares that I've seen in a long time. People in the space of just a few hours went from being incredibly pessimistic to incredibly optimistic. The reality is, of course, lies somewhere between. China is growing, the demand for our raw materials is therefore also growing, and as a result our economy is a pretty safe place to be compared to those troubled areas like North America and in particular Western Europe. Now, what's happened in the last few days will have far-reaching consequences for the rates of interest, both here in Australia and overseas. Now, last night, Ben Bernanke, the head of the US Federal Reserve, came out and said that US rates would stay where they are now, which is between 0 and 0.25%, for at least the next 2 years. Good news for property investors is that China's inflation rate came out yesterday, but it was below expectations for China. As a result, it now seems unlikely that Chinese interest rates will be raised further. Finally, here in Australia, there is, I think, an awakening at the Reserve Bank. There's realisation that at 4.75%, Australian interest rates are too high. While our economy is strong, it could suffer a crisis of confidence. And if late 2008, early 2009 is any pattern to go by, we could see rates being cut by as much as 1 to 1.5%. And that would be very good news for property investors. As I mentioned a number of times before in this segment, quite often the property market and the share market move in different directions, especially when shares are very volatile like they are right now. People often turn to the perceived safety of bricks and mortar. As a result, I expect a lot of money to start exiting the share market if it hasn't already done so. And one of the obvious places for it to go to is the property market. Now, whether it's residential, commercial, industrial, whatever, the point is property at the moment offers a relative oasis of safety that shares simply do not. A lot of financial advisors are now telling their clients to get into property. Combine that with the forecast cut in interest rates, and I think you'll have a pretty positive reaction in the property market towards the end of the year. I'm Tom Elliott for Hodges Real Estate. Thanks for listening to the Market Report, and I'll look forward to your company again, same time next month.